Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange in Miami. Joining me for this segment, we have Ben Slavin, Global Head of ETFs at BNY Mellon, to discuss key trends that we're seeing in this space at Exchange as well as for 2024. Ben, it's great to see you as always.
Good to see you, Jill.
From New York to Florida, here we are. What are some of the trends that you're hearing in Exchange 2024, some of the real key ones that you expect to play out for the year?
Well, there's a few. Certainly actively managed ETFs are what everybody's talking about, and I think it's coming in a couple fashions. One is just new product, and we saw a record number of actively managed ETFs issued last year. In fact, over 75% of the new ETFs launched, which was a record, by the way, were actively managed. But also we're seeing a lot of new entrants. So if you look around at this conference, there's all of the typical ETF issuers, but also some new names. Name brand asset managers and other asset managers from outside the US who are looking for ways to get into the ETF market, and actively managed product is really what they're intending to launch.
Why do you think we're seeing growth in active? Is it because the composition of the market has changed? Is it because we're seeing more thematic ETFs getting launched? Why are we getting this growth in active?
A little bit of everything. I think part of it is certainly that's where the white space is in the market. I mean, certainly all the passive, or at least the major passive benchmarks and then some, are actually taken. So active is really where there's more open space for asset managers to compete. Second, it's really part of the legacy of the industry, right? Where now investors are preferring the ETF structure over mutual funds. And so you just meet their clients where they're at. And I think there's a little bit that's part of where we're at in the market cycle, where the market's obviously had a big run up, and now we're seeing a lot of advisors starting to decide, hey, where should I be putting my money? And maybe the momentum-driven passive indexes could have run their course, and we're going to start to allocate a little more to active, which of course has the industry looking to capture those flows.
Starting to hear a lot about it in fixed income. It seems to be every conversation we're having, it's active fixed income as people are thinking about, okay, rates might be coming down, duration is going to start to shift around, but it feels like active fixed income is the big part of it.
Yeah, I think it's a little bit of a few different things that are all coming together for this trend, right? On the fixed income side, more advisors are interested or able to have a view on the equity markets. Large versus small, domestic versus international, those kinds of trades. When it comes to fixed income, not as many are looking at the market having a view on rates or on credit, and they're more willing to turn that over to an active manager to manage their fixed income position. But also we've seen a rotation. There's money in motion. So we've seen money coming out of the short end of the curve. So if you look at the flows really in the last few months for ETFs, that money is flowing out of the short end. This is the less than 1 year duration treasuries primarily, into longer duration assets, intermediate to longer duration, and they're moving from government to credit to try to capture some additional yield and also play this part of the rate cycle.
And at BNY Mellon specifically, any new products? How are you continuing to innovate in the ETF space?
Well, quite a bit. I think from an asset servicing standpoint, actually, we just had an announcement about some new technology that we're rolling out. And that technology is all about providing some additional automation to what's known in the industry as baskets. And this is really where the process starts. And it really is designed to help remove some of the operating friction in the market. Basically to help make it easier for our issuer clients, but also the liquidity providers to handle all this volume, handle all this new product, and put some automation around this process, which was already there, but this is really the next generation to, again, facilitate all this growth and a lot of these active products we're talking about here.
All right, Ben, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.